Welcome to our weekly High Rock video. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at highrockcapital.ca. I'm Scott Tomlinson, and my partner and colleague and the founder of High Rock, Paul Tepsich, is busy this week with some meetings, so I'll be flying solo. Well, last week I spent part of the week visiting clients and prospective clients in Calgary and Vancouver, having lots of discussions about the current economic climate, the financial markets, and some of their concerns about the management of their wealth. As usual, it was great to hear their questions and gain some important insight into their thinking. A common topic amongst all was the amount of cash equivalent assets that we are presently holding. I thought I would use today to address the whys and wherefores of our overweight position in that asset class. Basically, it's a function of where we currently are in the context of the economic cycle, which is circled in yellow on this graph. The red arrows represent all the economic cycles since the 1960s. This particular cycle that we're in now began in 2009 following the end of the financial crisis and recession of 2008. It is close to its end, and in fact, if not for what we might call the Trump bump, it might have already ended. But the tax cuts and hope for other fiscal stimulus from the current US administration gave it a little bit more life. We know, as with all cycles of the past, it will come to an end and a new one will begin. Exactly when is not perfect science, although it is not something that we are prepared to take a chance on. As we have pointed out often on these calls in the past, when the yield curve gets flat and the 2-year to 30-year bond yield spreads approach zero, recessions historically follow. Now, there's no reason to think that with rising short-term rates and more to come from the US Federal Reserve and falling longer-term yields, that this situation will not continue. So we have, since the middle of 2016 and well into the cycle, taken the view that holding our normal weight of equity assets in the global equity model would be adding risk that we did not want in our portfolios. In 2015, it was a difficult year for equity markets, which set us up to do some buying in early 2016. Clients who were with us at that time saw some buying and realized the fruition of some good opportunity then. But with the advent of the US election later that year, we did not want to take on any new risk. And as markets in the US rose through 2017, equity assets became more and more expensive, and we chose not to add expensive risk assets in keeping with the late stage of the economic cycle. Well, as you all may remember, our global equity benchmark is partly comprised of companies is partly the All Country World Index, the ACWI ETF. A little over 50% of this index is comprised of companies that are based in the US. About 8% are in Japan, 6% in the UK, and about 3% in Canada, the rest distributed across the globe. Now, as we look at how US stocks have been priced through the economic cycle, we note that early on in the cycle, when investors were less confident, in expected earnings-led stock prices. So stock prices had some value, and it was a good time for us to take on greater risk. But as we moved through the cycle, the circumstance changed and stock prices started to lead earnings. As investors became more confident and prices became more expensive, which is for us a signal to be taking on less risk, we know that at some point stock prices will once again be led by expected earnings growth as the cycle draws to a close. The stock prices are still above the 5-year average and well above the 10-year average, and will, like everything, in time, revert back to the mean. And that's prices and the price earnings ratio that we're looking at here. Well, through 2017, global stock prices did move higher, as I said. TSX prices moved lower, actually, and bond prices remained fairly flat to slightly lower, so that for that 1 year, our fully invested but still underweight equity portfolios were up, but likely less than the benchmark ACWI on an absolute return basis. However, over the full cycle, our portfolios have performed well, both with absolute annual average returns and with our risk-adjusted returns. Perhaps better at the beginning of the cycle as we employed higher levels of risk that we felt were warranted. But as the cycle progressed, we reduced risk in order to preserve our gains and our capital and take less risk as equity prices became more and more expensive. And that is how we sit today, waiting for lower, less expensive equity prices as this cycle ends and a new one begins. So I hope that gives you a good general level of our investing process through the whole economic cycle. Remember also that we look for our average annual returns to compound through the cycle. If we can avoid losses, then we can avoid losing important downtime momentum for compounding our returns. So that is it for this week. Thanks for taking the time to tune in. Again, we always appreciate your feedback and want you to feel free to send in questions and concerns. But until next week, we hope you have a great rest of the week and a wonderful weekend.